split dollar, and it's, for those of you that are familiar with it, it's been around a long time. Some of you, this may be new to you, but I can remember back in 2002 when there were some tax code changes to split dollar, and our industry kind of overreacted and freaked out and said, oh my gosh, this is one of the greatest planning tools, both for business planning as well as estate planning, and it's gone. Split dollar's dead. And so it reminds me of that saying, you know, split dollar's dead, long live split dollar. And so this truly is one of my favorite techniques for, as I said, estate planning as well as business planning. And I think you're going to see the flexibility in the two specific types of split dollar that are available to your clients. And so with that, I'm going to have Bill start off with a couple of slides here and get you into kind of the basics of split dollar as we go along today. So Bill.
Thank you, Eric. Thank you, Eric. Pleasure to be here. Pleasure to share a presentation with Eric, one of the finest people in the industry. And you know, I always start out presentations these days by just letting you know we're thinking about all of you, millions of people being impacted throughout the world with this current crisis we're in, and you know, we're certainly here to help you in any way that we can. And so feel free to reach out to us during this tough time. And building on that, part of the reason we wanted to start out with split dollar in this presentation series, in this training camp series, is because it really works well under the current conditions. So, you know, we all right now are dealing with immense challenges. I know all of you are. Just trying to meet with someone in person may be challenging. Getting a paramed. Carriers, including us, have put restrictions on for ages, and foreign national programs have been restricted. Really tough on all of you. So it's important, I think, for all of us, whether personally or in a business sense, to look for those gems. What are the positives out there right now? And there certainly is two of them with split dollar. And first and foremost, and we're going to be talking about this quite a bit throughout the presentation, is interest rates. Interest rates are extremely low. They have been low for many years, and they're lower even recently. I don't think, you know, we've been looking at interest rates now for years. I deal with it primarily on the premium finance side, and there wasn't anybody I talked to 2 years ago who would have thought that interest rates would be where they're at in 2020. The economy started booming, and everyone just expected interest rates were going to rise, and that was the universal opinion. And lo and behold, what's happened? They're even lower, and so that is a really huge benefit for split dollar, and we'll talk about that in a minute. Why that's so important to this strategy. The other thing is corporate tax rates. So, as you all know, in 2017, seems like forever now at this point, but at the end of 2017, Congress passed the Tax Act. It was signed by the president, and it did a lot of things, but for purposes of this presentation, and maybe most importantly overall, it considerably slashed tax rates for C corporations down from 35% to 21%, where it currently is today. So for those of you who have clients who own C Corps, who run C Corps, keeping that money within the C Corp and not distributing it, and maintaining that very low tax rate for that money that is brought in is really big opportunity. And we'll talk about why that's important today in split dollar. So this is meant to be a 101 course, but we certainly welcome people of all levels to listen in, you know, refresh possibly, to learn something. We do encourage questions, as Kyle mentioned. We'll have time for questions at the end of the presentation, and we'll get to as many as we can. You know, when I started many years ago in this field, split dollar to me was intimidating, and probably to many of you who don't deal with it regularly, it can be intimidating. I think just the word split dollar is kind of quirky. There's a lot of IRS regulations that you probably heard that that regulate how split dollar works and how it's taxed. We're going to talk about things like loan regime, and loan regime itself can sound pretty intimidating. But when you boil it down and you really look at how it works, it's really pretty straightforward and simple. And I hope that coming out of this presentation, you'll have a pretty good understanding and maybe be a little bit less intimidated and be willing to talk about it with your clients, because we're just in a great environment right now to consider this option. I do want to encourage you to join our 201 call later today at 3 o'clock Central, where we're going to have Dave Graham and Randy Zipsey, two of the finest people in the advanced markets arena, to be presenting on this concept, but a little more complex in some of the places you can take it, because there is many ways to use split dollar, and they'll give you some more ideas later on today. So let's get into the presentation. We, of course, have our legal disclosure here because we're going to be talking about tax. And so I, of course, don't give tax advice, nor does anyone who is employed by Global Atlantic. And you certainly, with these strategies, should work with advisors. And we'll even talk a little bit more about that. There should be legal agreements that are part of any split dollar arrangement. So what is split dollar, first of all? So it's not a product. It's not a reason to buy life insurance. It is a strategy using permanent life insurance. And we here at Global Atlantic encourage and think that Index Universal Life is a great way, a great product to use in a split dollar plan, but you don't necessarily have to use Index Universal Life. You could use another permanent product such as whole life or variable. So it is a strategy that involves the splitting of the cost of the policy, the cash value in the policy, and or the death benefit. And so what you usually have is one party who needs insurance and will benefit from the insurance, typically the employee, and the premium is paid by another party, typically the employer. So as Eric mentioned to you, there are multiple uses for split dollar. The most common ways to use split dollar are in a business sense, in an employee-employer relationship. And that's what we're going to focus on today, because that's probably the most common place you're going to see this. The most opportunities are in that arena. But split dollar also can be used in estate planning. And we'll talk about that in a minute, but I'm not going to go into depth today on estate planning uses for split dollar, just because it just adds a little more complexity, and it's not the most common way that you're likely going to find opportunities. Certainly, I'll say this overall, you're always free to reach out to anyone on my team, including myself, and we're happy to go over these concepts one-on-one or in a group setting with you. So why would you use split dollar? Let's start with. Yep.
Sorry are your slides advancing?
Yeah. Are you not seeing it?
I am not. Oh, there it is. Oh.
One sec. Do you not see what is split dollar?
There it is now.
Got it? Okay.
Yep.
Okay. So why would your clients consider split dollar? So in the business sense, this is going to be an executive benefit primarily. This is going to be a very attractive way to give a benefit to employees, both death benefit and cash value. And again, we're gonna dive into this, but it's a very attractive, especially right now due to the low interest rates. And we're going to talk about the loan regime part of split dollar, and that is based on a loan from the employer to the employee. And because interest rates are so low right now, it's extremely attractive to employees. It's attractive to employers because they're going to be able to have cost recovery. They're going to be able to get all of their money back whatever they put into the policy under this strategy, they likely will be able to recover all of that money back. So that's a great benefit to the employee and to the employer. Now, for those of you who understand how this works, there is a little loss there in the ability to use that money because they're going to be paying premiums. They're eventually going to get it all back, but they might miss out on 10, 15 years that they could use that money and invest it. So there is that to consider. Of course, their investments could go lower over those 10 to 15 years. So there is a side to the coin on that. But it's very attractive to employers because they can get their money back. Very briefly, we'll talk about some regulations. ERISA usually will not apply. These are usually used with top-level executives, key employees who are part of what's called a top hat group. So typically, there's no ERISA requirements. So there's a lot of flexibility. There's the ability to discriminate among employees, and there's a lot less regulation in these plans. Now, from a
Bill,
state,
if I could just interrupt for a second, I'm going to take control of the slides because we're still not seeing them in advance. So if you could stop your share here, and then I'll be your slide runner here.
All right, thanks, Donald.
Yep.
So with estate planning, this can also be a very good strategy. And without going into too much detail, basically you're able to transfer money into an ILIT without worrying so much about gift taxes, because when you do transfer money into an irrevocable life insurance trust, there are limitations on what you can transfer over without incurring gift tax. And by engaging in a split dollar plan and loaning the money, you can more efficiently transfer money with the current tax requirements. So that's just in a quick nutshell why you might use this for estate planning. But again, throughout this presentation, we're going to focus on the employer-employee relationship and using this in a business setting. So on this slide here that Donald's brought up, you see the two types of split dollar. You see loan regime and economic benefit regime. Most of this presentation, we're going to talk about loan regime because that is the type of split dollar that can take advantage of the current low interest rate environment. So we're going to spend most of our time talking about loan regime, but we will wrap up the presentation by discussing what economic benefit regime is and when it can be useful. So Donald, you can go to the next slide. All right, so here's a quick graph of what loan regime split dollar is. So you see in the top left box, you see the employer, and they are going to loan funds to the employee, and the purpose of that loan is to pay the premiums on the life insurance policy. So you see number 2 there, you see the employee taking that loan and paying the premium to the life insurance company. Now the employer is going to put a collateral assignment on the policy. We have that form already available. If a company would prefer to use a different form, we can do that. We just have to review it in advance. But basically, that's going to protect the company's loan. They're loaning the money to the employee for the policy, and they want to make sure that they ultimately get all that money back. And to make sure the employee doesn't just take that money, take distributions out of the policy, they assign it to the employer, and the employer basically has control of the policy while that assignment is in place. And the employee can't take any money out of the policy while the collateral assignment is in place. So at some point, the employee is going to repay the loan to the employer. We'll talk about that in a couple case studies. There's different ways to do that. Probably the most common way is to take a distribution out of the policy and to pay off the loan, so the employee is not taking anything out of pocket per se. Another way to do it is to roll out at death. There's some downsides to that, but that's another option where the employer could get their money back through the death benefit. And then at the end of the day, the life insurance proceeds are going to be paid out to the employee's beneficiary. It is important to note on this type of split dollar plan, the employee is going to be the owner of the policy. So the employee will own the policy, they will be the insured, they will select the beneficiaries, but the employer will have that collateral assignment in place to recoup the amount that they loaned out for premiums. Donald, you can go ahead. So this slide shows the current May 2020 AFR rates. AFR stands for applicable federal rates. And so you'll see this will be more clear once we go into the case studies and see the illustrations. But whenever there's a loan, there has to be an interest rate, all right? The government will not allow a loan, usually, without an interest rate. Otherwise, it won't qualify as a loan. And that money that's transferred from the employer to the employee would be treated as income and taxable. And so we want to avoid that taxable income. So it's treated as a loan, but there has to be an interest rate. So what the IRS has done is set a floor based on the current interest rate environment of what that rate has to be. And so there's short-term loans, there's mid-term loans, there's long-term loans, and we can get into that at some point. But typically in a split dollar arrangement, you're going to use the long-term loan. And so you see that right now, that rate is 1.15%. Again, very, very low. Historically, paying 1% on a loan is pretty close to zero. And so that's what makes this so attractive. And you'll see that illustrated out in a minute. But what's important to note is that once the employer makes that loan, so say you had a client who engaged in a split dollar agreement and they loan the money to the employee to buy a life insurance policy, that rate is locked in. So we're going to look at an illustration, and typically in these structures, you'll have, say, 7 different loans because you'll do a 7-pay, and that loan rate is going to change for when the loan is made. But when the loan is made, when the money is transferred to the employee, that rate locks in. So whatever loan is made in May 2020, it's going to lock in at 1.15% and change. If they make another premium payment 12 months from now in May 2021 and have a second loan for the second premium payment, there might be a different rate. There probably will be, either higher or lower. But for the money that they loan in May 2020, locks in at 1.15%. So that's what's going to make this very attractive. So we're going to move into case studies in a minute, but I would like to transfer it over to Eric.
Thank you, Bill. This is one of the best parts of split dollar, what you just covered, Bill, with the flexibility in the loans, the low interest rates, and that unlike any other loan you may have, save your mortgage, if you compare and contrast this to, say, premium financing, that rate's going to change annually. This loan is going to stay the same rate with the same premium when it was loaned each and every year. So it's a lot easier to manage client expectations. So, where's a good place? So you and I were talking recently, Bill. Where are some of the opportunities for split dollar? And I see that one of my old friends, Rob Reed, is on today from CPS Peloton, and we used to do a lot of joint presentations together. And that was always a question: was whatever your topic is, how wide or how narrow is the market? And I think you'd agree that the market for this, especially in, not talking about the estate planning, but just in the business market, it's far and wide, almost as if you could have a handful of pebbles, assuming we're not, still quarantined, but spin around outside, and wherever a pebble lands in a business district, you've got clients. So most times people think about your traditional C Corp businesses as a prospect, and they are absolutely a great prospect for this. But it's worth noting that if the company is publicly traded, they are prohibited from using split dollar loan regime because of the Sarbanes-Oxley Act that was put into place about 10 years or so ago, maybe a little bit more. But where else could you find? What is a real hotbed, Bill, that we could go after and find opportunities? Well, I'll say it's real simple. It's in the nonprofit arena. And what are some of the, say, the top 3 nonprofit arenas? Well, those would be credit unions, hospital systems, universities, university medical systems, okay? And why? The why is simply that in these nonprofit organizations, they are restricted to their 403B plan and or a 457 plan, which is not very attractive to executives. They're not too interested in a traditional type of COLI plan where they would have to bonus a certain amount of money to make it meaningful. And there's also the excise tax. So over $1 million, you get an excise tax penalty of 20%. All of that's not, makes a traditional executive benefit plan not attractive. Whereas split dollar is a loan, so we're not worrying about any type of additional compensation that can be found out by the public. We're not worried about any excise penalties, and we're also not concerned with a lot of different administration issues that you would typically see in these plans. So really the biggest opportunities that we've been seeing, Bill, I think you would agree, as a company, has been not only just the traditional for-profit C Corp, but also in the nonprofits.
Yeah,
and I think we're going to talk about one that really fits that exact scenario.
Yeah, definitely. Great examples. Let's get into the case studies. Before I do that, there was just a couple quick questions that I just wanted to address on the AFR. So you'll see there's 110%, 120% of AFR. That's just something that the IRS puts out there on their page just to provide some clarity. So if you wanted to have a loan agreement with 130% of AFR, you could probably do the math, but they spell it out there. It's 1.51%. But for purposes of these arrangements, employers are going to want to go to the lowest. So you can ignore the 110, 120, 130. Just look at the AFR, the lowest rate. That's the lowest it can be and where they're going to want to have it. And also there was a question about how long can the loan be. So for the long-term AFR, it should be 9 years or longer, the term of the loan. And that's typically what these are. They're typically going to span 10 years or longer. So that's why you would use the long-term AFR, but there's no cap. There's no cap on that number of years. It can go well beyond 9. So Donald, if you could,
it can go to the death. It can go to death of the client, Bill, as you mentioned earlier.
Yep.
One of the questions that did come up. One of the questions that did come up was, can we use a premium deposit rider to borrow the loan all at one time? You can. However, Global Atlantic does not have currently a premium deposit fund or premium deposit rider. But in common practice, especially in the nonprofit arena, a lot of these nonprofits will set up a premium deposit trust. And you can always reach out to Bill, Randy Zipsey, or myself offline, and we can talk about how that works. But it's accomplishing the same thing. It's just the trust is part and parcel or party to the split dollar transaction in the first place, so that the nonprofit can throw all the premium into that trust, and it will act just like a premium deposit fund that you're all used to. So thank you for those questions.
Thanks, Eric. Donald, if you could move on. So when you talk about split dollar, it's hard to avoid Jim Harbaugh. You may have heard about this. It's been several years now, but there was some really good press for cash value life insurance. It was great to see, because oftentimes you see some people in the media who are negative against our product. But so it was great to see some really good publicity. And this was an article. There was articles throughout newspapers in the country, if you Google it, about Jim Harbaugh using split dollar and cash value life insurance to become college football's top paid coach. So I thought it would be kind of fun to go through and just show you this briefly, how the structure of his agreement works, and then we can move on to a more real life example. But as you see on the slide, there was some information that was publicly disclosed because Jim works for a public university. We're able to get some information. We don't know all the details of it, and I did take some liberties, to be honest, in my case study, because I don't have all of the information. But essentially, you had a $35 million IUL that was going to grow to $50 million, and the plan was for Harbaugh to take out about $1.5 million per year in distributions. from age 66 to 98 for a total of around $50 million. Was how this plan was set out and strategized. Interest rates were low. This happened, I think, about 5 years ago now at this point, and interest rates were low then. They continue to be low and probably lower at this point, so it's even more attractive at this point to engage in the split dollar plan. So, Donald, go to the next slide, and we can look at how this works. This is a split dollar supplemental report on our illustration system, so available for all of you to design your plans. And if you need help with this, feel free to reach out and we can assist you with it. But it's pretty straightforward. As you're building your illustration, you can create this report in order to lay this out for your clients. We'll talk later. We also have a Design Hub module. I'll talk about that very briefly at the end. But we've created some in-house software to create concepts, and this is the one that we've used. So I think we've done some things even better than what's on here, but I thought this was a good example for the 101 to show you. So here you see on the left side, you see policy years 1 through 15. Harbaugh was, I believe, 53 at the time that he entered into this strategy. And on the third column, you'll see the premium payments, $1.75 million a year for 7 years. They max paid this at the 7 pay. So each of those premium payments is going to be a loan from the University of Michigan to Harbaugh. So that's what I was explaining before. Each premium payment is going to be a loan. So say this happened today, in May 2020, you're going to have a loan for $1.75 million, and the interest rate on that is going to be 1.15%, and that rate will lock in. So for that loan, that $1.75 million, it's going to have that rate permanently until the loan is finished and paid off. For year 2, in May 2021, for example, another $1.75 million loan will be made to Harbaugh, and at that point, the interest rate will be different, almost certainly in some way, either higher or lower. And then at that point, it will lock in permanently. So I think that gives a good example of how this works. You see at the top of the page, I used a 3% interest rate. So it can become challenging when you're dealing with interest rates, trying to predict. None of us can predict exactly where interest rates are going to go, but you can put in an average. And basically, you're looking, when you're designing this, the easiest way to do it is to have an average. You could go in and put an interest rate for each year and calculate that. But when you're showing it to a client, usually it's sufficient to show them what an anticipated average interest rate is going to be over the life of the plan. So that's what we did here for purposes of simplicity. In the fourth column, you see the cash value that's growing and would be available for the University of Michigan so that they can get their money back. You also see the death benefit that would be available for the University of Michigan. So in those columns, after year 7, you see them both capped out at $12.25 million. So that's going to be the amount of money that they loaned to Harbaugh over 7 years and what they will anticipate to receive back, either at Harbaugh's death, which I understand is the plan here, or sooner if they would roll out of this plan for some reason. Now we go over, you see there's a second group here, and this is the benefits for Jim Harbaugh. So in the first column of that section on the right, we see the imputed interest. So that is simply the 1.75 times 3%. That is the amount of interest on the loan, and also what is determined to be his income. Because how these work practically is Jim is not writing a check for $52,000 to the University of Michigan. That interest is just being forgiven. And so it turns into income, and it's put on his W-2 as taxable income. Jim's tax rate, I believe we put in 37%. So you see on that $52,000 in the next column, he's going to owe about $20,000 in taxes that first year for this plan, going up to and capping out around $135,000 per year that would be included as or I'm sorry, $367,000, which would be included as taxable income, resulting in him, if he stays in that tax bracket, paying $135,000 a year. And then in the next columns, you see what his outlay is. He's not paying anything out of pocket. It's all zeros. And then ultimately what he can expect to be his share of the cash value and his death benefit. So Donald, if you could go to the next slide. We fast forward out many years to, let's go to year 30 of the policy at age 83. Still Michigan has paid out the $12.2 million, and they can expect that back. Jim is still paying $135,000 in taxes every year, but he has a very large amount of cash value, $48 million at age 83, with the executive death benefit, his death benefit to his heirs of $51 million. So in this plan, I understand that the goal is to roll out at death. And so there's positives and negatives to doing that. The positive is that cash is going to continue to grow in the policy. There's no lien on it. I don't know what product he used, so I don't know exactly how it's going to be structured. But the downside is he's going to continue to pay. He's going to continue to pay taxes on it. So let's move to another example, a more real life example of this. And this one is going to show a rollout. So here we have a 45-year-old executive, preferred 32% tax bracket. And we're again going to use that 3% AFR, because although if this executive enters into the agreement today and gets the loan today, the rate's going to be 1.15%, not 3. But because these plans typically are paid out over 7 years, we're going to increase that loan rate a little bit to 3%. So we're using our global accumulator product here, a $2 million face, $80,000 annual premium, and we're going to roll out in year 15. So Donald, you can go to the next slide. So here we see that this is the same exact supplemental report that I used on the Jim Harbaugh case. So here we have $80,000 paid out per year, loaned to the employee, and then used for premium for the policy. Totaling $560,000 is the outlay from the company. They'll file a collateral assignment with us to protect that $560,000, so they'll be able to recoup that either through the cash value or the death benefit. We see, based on 3%, we see the amount of interest that is going to be put on the W-2, that forgiven interest that the employee is not going to physically pay. It's going to be forgiven and put on their W-2. And then we see the taxes. After 14 years, the employee is going to pay about $38,000 in taxes, so about $2,800 per year over those 14 years from age 46 to 59. And we see the cash building in the policy and the death benefit. So at year 15, after what you see on this slide, a loan is going to be taken out of the policy for $560,000, and then we fast forward a couple of years to retirement. So age 66, you see the company has been paid off. They no longer have any interest in the policy. The loan has been paid off. There's no more interest that's being imputed. There's no more tax to pay. And the employee walks away with a really nice benefit in retirement. In year 21 at age 66, they have a little over $500,000 in cash value. They still have that $2 million death benefit that's going to be unencumbered for their beneficiaries. And the company has received all the money that they paid out. 15 years later, all that money they paid out to the executive is paid off. So there was, and I apologize here, someone just did send a note and said, well, how was it paid off? I don't have that year 15 on here. I'm sorry. But basically all we did was take a loan out of the policy and pay off the loan from the employer. So you see all the cash value figures and death benefit figures here on this slide from age 66 forward reflect that $560,000 loan taken out of the policy. All right, I want to move quickly to economic benefit. So this is another type of split dollar, and frankly, it's not as attractive as loan regime. So you're not going to see this used regularly in a current scenario. Most employers are going to look to loan regime. But this is a little simpler and there is some flexibility here. So basically the employer here is going to own the policy. It's going to be a company owned policy and they're going to endorse an amount of the death benefit over. So say the death benefit is $200,000, they can give $100,000 of coverage to the employee and they're simply going to endorse it over to them. The employer is going to pay the premiums there on number 2. You see that they're paying the premiums to the life insurance company. The employee is going to name a death benefit, they're going to name a beneficiary, and that beneficiary is going to receive the death benefit. Now, the amount of the value of that insurance, and I'll show you how this works in a second, is going to be treated as income to the employee. So Donald, if you go to the next slide, we can show how that works. So this just shows the case study. It's actually the same person, same product, same premiums as we used on the previous case study. So you can go to the next slide, Donald. Okay, so here we see $80,000 being paid out. Again, this is not a loan here. The company owns the policy. They're paying the premium. They are entitled to get back the higher of the premiums paid, $560,000, or the cash value, right? That's legally they're required to get either the higher of the premiums paid or the cash value. Now we see an economic benefit in there. So this employee has been given 1.9 million, we'll just say 2 million of insurance. And based on a government table, it's called the Table 2001, the government has valued that at $3,000 in year 1. At their tax bracket, they owe almost $1,000 in tax at their tax bracket. So now how do you determine that economic benefit there in that first column under executive? That's based on the Table 2001 rates. We have those available on our website. The government has basically said this is what the value of $2 million of insurance for a 46-year-old is. The government has created that table. Now there is a way to lower this, and we are working on that, and we hope to have it at some point in the near future. And instead of using the government rates, you can use the rates on a 1-year term product. Right? We don't have one, most companies don't, but we're working on having that so that column can be lower. And when the environment is right for economic benefit, we can be a go-to carrier for that. So Donald, you can go on to the next slide. If you go one more, Donald, real quick. All right, we have a couple minutes for questions. I know we're pushing the end of the presentation. We'll email you if we don't get to your question. I do want to let you know we do have good resources at globalatlanticlife.com. We have a split dollar guide that goes into this very in depth. We have some documents that can help you, client-facing materials. We have sample agreements. So if you want to see what a legal agreement would look like, we can have sample agreements that you can share with the attorney. And as I mentioned, we also have a design hub module that can run a customized split dollar report for a client. So Donald, if you want to go back to questions.
Yeah. So Bill or Eric, so is the loan ever refinanced? So like an old split dollar plans, that were maybe set up, are they able to refinance those loans to the new lower rates?
Yes, you can certainly do that. It's a very simple process. You just would basically transfer the loan the outstanding loan amount over to a new loan, and you don't physically have to transfer the money. You just have to transfer the balance and create new loan documents. And yes, you can refinance a loan. There are a lot of strategies that, if you look at the short-term rates, which are loans 3 years and less, people will use those rates to start out a plan and then switch over, refinance, and switch over to a long-term loan. So yes, the answer is yes. It gets a little complicated, but you can do it.
So another one that I saw that I think was answered in the Q&A typing, but I think it'd be good just to kind of address, maybe talk a little bit more about why corporations would loan at such a low rate to somebody, and why this is advantageous for corporations.
Sure.
Yeah, so
I can
corporations.
take that, Bill. Go ahead.
Okay.
Go ahead, Bill. Go on.
No, go ahead, Eric.
So what I was going to say is that the AFR rates are the minimum required rates by the IRS. Okay, this is certainly not the maximum. Company could charge much higher if they wanted to. However, keep in mind, these plans are put in to motivate, retain, and reward key employees, executives, and or for the owners as well. So if you think about it from that perspective, why would you charge a higher rate? This is not an investment income or an interest income play for the business. Not at all. This is purely a way of loaning money to provide a meaningful benefit to the executives of a business. I hope that answers, and Bill, please add to it if you'd like.
Yeah, I think, in these situations, the company wants to provide a really nice benefit, and they could just simply bonus the money out. But what's going to happen is that the client's going to get hit with a heavy income tax bill as a result of that. So this is a way to transfer money to an employee, or in fact to an owner. So someone who owns a C Corp and wants to take advantage of the lower C Corp rates, they just want to transfer that money out to the employee in a tax efficient way. On top of it, if they so choose, they can recoup all of that money through a loan. So that's another benefit for the company as well.
So we got a couple more, and I know we're right up on the time, but I think a good one here is how does that employer protect that key employee from leaving?
Yeah. So the company, the company has a collateral assignment on the policy, and there's so much, so that they're protected, and there's so much flexibility here because it's not regulated by ERISA. They can create whatever agreement they want. So, and we can talk more about this in another session or one-on-one, but you can include in that agreement some golden handcuffs, is the term, to make that employee incentivized to stay. And so that's another topic, but there is a lot of flexibility here that you can put in these agreements.
So I think we have quite a few other questions, and I know we're up against it on time. I think we can put together kind of a Q&A to send out. We'll send out with the recording. So Eric and Bill, if I can tap you guys to help us on answering those. But we really appreciate Eric and Bill, you guys jumping on here to kind of walk through and go through this split dollar and how it can be used out there in the field. Really appreciate everyone who's jumped online to listen today. There will be a 201 session later this afternoon where it'll go a little bit deeper, a little more advanced into split dollar. And then next week, we will be hosting a couple of webinars on the multiplier marketplace and what's been happening in IUL product design, and talking a little bit more about that. So watch for that next week, and then additional topics for the month following that, as well as we continue our summer training camp series. So Bill, Eric, Kyle, everyone, thank you for putting this on, and everyone who has attended, thank you for participating in today's webinar, and we look forward to seeing you on our next one.
Thank you.
Thanks, everyone.